Cryptocurrencies are very popular right now. Lots of people have already invested in it. Some people even invested in things called non-fungible tokens. These are tokens that are different from each other. The US government is now asking for some people's money from investing in NFT. The OECD has been trying to develop new tax standards for the digital economy for a long time. The project that started it all was the base erosion and profit-shifting project in 2015. This project focused on how consumer behavior has changed because of the digital economy. In a nutshell, BEPS created a playbook for tax authorities worldwide to implement specific taxes on cross-border and direct-to-consumer digital transactions. The idea was to tax services based on where the customer consumed them, not where the company providing them was based. BEPS was talked about a lot before it was fully codified. Now, tax authorities worldwide are using it as an excuse to increase taxes on digital services. The UK did this with the Digital Services Act, and other countries like the EU, Italy, Spain, and Chile have proposed similar ideas. So far, most prominent tech companies have avoided paying more taxes by not providing their services in those countries or passing the cost onto their suppliers and customers. Global regulation is starting to progress on this issue, but it has taken long. That same trend is now happening with digital assets. But this time, investors are responsible, including both sophisticated institutions and novice investors looking to get in on the latest trend. The number of people buying NFT hit 260,000 in the third quarter of 2021. This is a significant increase from the 19,000 people who bought them during the same period in 2020. People buy NFT because they are unsure how taxes work on cryptocurrency investments. This is because NFT are in a gray area that has been a problem for cryptocurrency investors for years. NFT are unique and can be verified. People call them collectibles because many NFT are digitized versions of common collectibles, like trading cards. The rate for collectibles varies depending on how much someone is willing to pay for them, but it is usually more than 20%. This is more than the top rate for investment returns for stocks, bonds, and cryptocurrencies. For example, a single taxpayer in the 22% tax bracket would pay a 22% top rate on the long-term appreciation of collectibles. So it makes sense that someone who made $75,000 last year would have their gains on their collectible NFT taxed at 22%. But unfortunately, it's not that simple. The IRS has not said that non-fungible tokens NFT are collectibles. Because the IRS takes a long time to guide new things, we don't know if taxpayers who own NFT should be taxed at the higher collectible rate or the standard capital gains rate. People are still trying to figure out what to do about taxes for digital things. Some people think we need to have specific rules for things like NFT, but we haven't decided yet. People who invest in digital things have a choice to make. They can either pay more taxes or take a risk and hope that the rules will change soon. You need to be careful when it comes to taxes and NFT. The government is getting more interested in this type of investment, which means they want their share of the money you make. You don't want to get in trouble with the IRS, so make sure you stay compliant and informed.